Imagine a trader winning 80% of their trades, yet blowing their entire account in a single afternoon. Meanwhile, another trader wins only 30% of the time, yet consistently grows their portfolio week after week. Most retail traders fall right into this win rate trap. They focus entirely on how often they hit a winning position, treating every individual market loss as a personal failure or a flaw in their strategy. This chart illustrates a classic fat tail blowup, which happens when a system is built to win tiny amounts without a proper safety net. Dozens of consecutive wins creep up the board, then one massive loss drops the account well below where it started. To stop gambling, you have to completely detach from the need to be right every time you execute a trade. Long-term survival in the markets requires throwing out arbitrary success metrics in favor of a precise mathematical edge. In the casino business, they call this the house edge. In trading, we call it expectancy. It is the only objective measurement that tells you if your strategy actually works. This equation finds your edge: win rate times average win minus loss rate times average loss. Winning 40% of the time for $500, while losing 60% for $200, guarantees a positive expectancy of $80 per trade. The problem is that many traders try to measure these variables using pips. However, a 50-pip move on a stable pair, like the euro to dollar, carries a completely different risk profile than a 50-pip move on a highly volatile asset like gold. To fix this, professional traders use R multiples. R stands for your initial risk. If you risk $100 on a trade, that $100 is equal to 1R. It standardizes your metric, no matter what asset you are trading. Standardizing your performance into R multiples strips away the illusion of market volatility. It allows you to objectively compare a quick scalp against a long-term swing trade, revealing which system actually delivers the best mathematical return on your capital. But a positive mathematical backtest is only half the battle. Many strategies look highly profitable on paper, only to bleed money in live markets because they ignore operational overhead. This green bar is your theoretical return. Watch as it gets sliced down by market friction, spreads, broker commissions, and slippage. These costs easily consume thin margins, pushing a winning strategy into negative territory, which is why high-frequency systems require zero-spread environments. Even with friction accounted for, your expectancy equation needs one final multiplier to function correctly: the law of large numbers. Short-term variance is a statistical certainty within any profitable system. Even with a high-performing strategy, hitting 5 losses in a row is an expected part of the process, rather than evidence of a broken system. To prove your edge is real and not just a lucky streak, you need a minimum sample size of at least 100 executed trades. A mathematical edge means nothing without sufficient frequency. It is the sheer volume of execution that forces probability to overcome temporary variance. When those inevitable losses hit, traders often experience biological drawdown. It is a state of mental exhaustion that triggers the urge to revenge trade and break all your rules to recover the capital. Relying on your verified 100-trade expectancy data is what neutralizes that emotional response. It acts as an anchor, letting you recognize the current slump as standard variance. Every individual trade functions as a single unit of probability, where the odds lean slightly in your favor. A hit stop-loss represents a calculated business expense, identical to a casino paying out a winning slot machine to maintain its long-term edge. Mastering expectancy and standardizing risk transforms you from a gambler hoping for a lucky win into the house, operating a system that guarantees a return over time. Audit your last 50 trades using the expectancy calculator to verify your true edge.